You ever wonder how the pros really look at an investment? Well, it's not some kind of magic. It's a toolkit. And you know what? Over the next few minutes, we're going to build that toolkit together, breaking down the key statistical measures that separate smart analysis from just, simple guesswork.
Okay, so it all starts with a really simple question. You've got two choices, two potential investments. One might look better on the surface, but how do you really know which one's the winner? How do you compare them fairly to understand not just the potential reward, but all the hidden risks? Well, that's the puzzle we're going to solve today. All right, so step one, we've got to find let's call it the center of gravity for all our data. We need one single number that can represent the typical or expected outcome. Just think of it like finding a benchmark for performance, right?
And the very first tool we're going to pull out for this job is one you already know and love, the good old arithmetic mean. The average. We just add everything up and divide. Sounds simple, right? Well, mostly.
Yeah, you've definitely seen this formula before. It's the engine behind the average. Now, you don't need to memorize it, but it's helpful to see that every single data point gets an equal vote in the final number. But as we're about to find out, that can actually be a bit of a problem.
Okay, let's put this into practice. Imagine we're looking at the returns from a group of 5 portfolio managers. We can average them all out and get a single number that seems to represent the group's performance. It feels pretty solid, right? Like a good representation. But here's the thing. This method has a hidden weakness, a big one. What happens when one of those managers has a year that isn't just good, but completely off the charts? Okay, now let's just change one little thing. Let's imagine that first manager had a spectacular, once-in-a-lifetime year, a 100% return. Everybody else, their performance stays exactly the same. Suddenly, we have what's called an outlier, and believe me, it's about to completely wreck our calculation. Whoa. Suddenly, our mean shoots up from 22.8% all the way to 36.8%. So, I gotta ask you, does that new number really feel typical to you? I mean, 4 out of the 5 managers performed way below that. No way. That one outlier has totally warped our picture of what's really going on. And this is where our second tool swoops in to save the day, the median. The median is just the value that sits right smack in the middle when you line up all your data in order. And its superpower, it literally does not care about those crazy outliers. I mean, just look at the difference here. The mean, it's kind of like a seesaw, right? One really heavy outlier can just throw the whole thing off balance. It gives you a totally misleading picture. But the median, it just finds that middle point, completely ignoring the extremes. It gives us a much more honest, much more stable view of what's typical. So, key takeaway here. When your data has those wild values, the median is probably going to be your most honest friend. Okay, cool. So now we know how to find a typical return. But listen, that's only half the story. The other half, which is just as important, is getting a handle on the risk. How spread out are the results? How volatile is this ride going to be? So the fancy technical term for this is dispersion. It's all about how much the individual data points vary around that center point we just found. But in the world of finance, let's be real. Dispersion is just another word for risk. A wider spread means more uncertainty, and that means higher risk. And our go-to tool for measuring this is called standard deviation. The easiest way to think about it is this. It's one number that tells you the average distance of every single data point from the mean. A small standard deviation means all the returns are huddled up close to the average. That's a nice, smooth, predictable ride. A big one? Well, that means the results are scattered far and wide, a volatile roller coaster. But wait, there's more. We can get even more sophisticated than that. So we know the reward, we've got a number for the risk, but now let's add some color, some character to our understanding of that risk. What does the shape of the data actually tell us? And that brings us to this idea of skewness. A symmetrical distribution is perfectly balanced, but if it's lopsided, we say it's skewed. And this visual, it's perfect. If you have a long tail of rare but super positive results, like our 100% portfolio manager, it's positively skewed. And see how the mean gets dragged in the direction of that long tail? That's skewness. You want a perfect real-world analogy? I got one for you. Think about a neighborhood where pretty much every house is worth $100,000. But then there's one giant mansion on the hill worth $1 million. The median house price is still $100,000, but the mean, it gets janked way up by that one mansion. That, my friends, is positive skew in action. All right, our final tool for understanding the shape of risk is called kurtosis. And really, this is all about tail risk. See, some investments have what we call a fat-tailed distribution. That just means they have a much higher chance of extreme, shocking events, both good and bad, than you'd normally expect. For anyone managing risk, this is a massive red flag. This is basically the statistical signature of what people call black swan events. Those things nobody sees coming.
All right, our toolkit is getting pretty packed now, huh? But we've got one more problem to solve. How do you compare the risk of two totally different things? How do you compare the risk of, say, a super safe government bond versus the entire stock market? So let's take a look at this data here. The S&P 500 has a much higher average return, but it also has a massively higher standard deviation or risk. The numbers are on completely different planets. Trying to compare them directly is, well, it's classic apples and oranges. We need a way to get them on a level playing field.
And guess what? We have the perfect tool for exactly this situation. It's called the coefficient of variation, or CV for short. It's this really elegant little formula that tells you exactly how much risk you're taking on for every single unit of return you're hoping to get.
And would you look at that result? The second we standardize the risk, the picture becomes crystal clear. For T-bills, you're taking on about 1.4 units of risk for each unit of return. For the S&P 500, it's nearly 7. So here's the punchline. On a risk-adjusted basis, T-bills are way, way less volatile. The CV gives us that perfect apples-to-apples comparison we were looking for.
Okay, one last piece for our toolkit, I promise. So far, we've been looking at investments all by themselves. But that's not how the real world works, is it? So the final question we have to ask is, how do these things move together?
You know, the best place to start is often the simplest. Just look at the data. Throw it on a scatter plot. Sometimes you'll just see a random cloud of dots. No relationship there. But other times, a clear pattern jumps right out, like that strong upward trend in the second chart. You get this instant visual clue about how two things might be connected. Now, we can actually put a number on this relationship. It's called correlation. But listen up, because this might be the single most important lesson of this entire explainer. Correlation is not causation. For example, ice cream sales and shark attacks are highly correlated. But does eating ice cream make sharks attack people? Of course not. It's the hot weather, a third factor, that causes both. Correlation tells you that things move together, but it never, ever tells you why.
And just to make sure that point really, really sticks with you, let's end on this one. The correlation between U.S. spending on science and tech and the number of suicides by hanging is a near-perfect 99.87%. So, does one cause the other? Absolutely not. It's a textbook case of a spurious correlation. It's just a powerful reminder to always, always look deeper than the numbers on the page and really question what they're trying to tell you.
我是 T 纽约